Good evening, everyone. I'm Eric Scott, and welcome to another edition of Access New Jersey. You have worked your entire life to be able to retire, made more complicated in New Jersey by dealing with the highest tax burden in the nation. But have you ever asked yourself one simple question? What happens if you get sick? There is nothing that can destroy wealth faster than a serious illness, and if it happens in retirement, how would you pay for it, and where would you like to get your care? Tonight on Access New Jersey, my guest is Chris Lester from Professional Planning Services, and we're going to talk about some of the pitfalls that you may encounter and ways to protect everything you've spent a lifetime building. There are many options. There are no cookie-cutter approaches here, but the guidelines tonight may help you preserve what you have spent a lifetime of building. Chris and I began educating New Jersey 101.5 listeners on these types of matters nearly 20 years ago. And now that we are living in uncertain financial times and more of us are aging, it's an appropriate time to revisit what could happen and maybe talk about some of the assumptions you may have had surrounding the options you have and new options that you may have moving forward. Chris, thank you very much for joining us on Access New Jersey. Welcome back to New Jersey 101.5.
Thank you for having me, Eric, and really excited to be here and proud to be here. And looking forward to sharing information that I think is really important that we've discovered and learned over the years to make sure that people are at least revisiting some unpleasant and usually, just serious topics.
Sensitive stuff. And they're difficult conversations to have. And, that's why it's important that you've joined us tonight. That's why it's important that we have Chris here tonight, because nobody likes to think about these things. But we hope to prompt you tonight to ask the questions that need to be asked and search those answers so that you don't jeopardize your lifestyle in retirement. Before we get into some of those scenarios, Chris, let's talk a little bit about you. I mean, I've known you a long time. You're a Navy veteran, married, 4 kids, Jersey guy. You know what people have been working for. How did you get from that point to where we are sitting tonight?
So I am certainly blessed, but I am typically, what I share is that, at an early age, I went into the military to be a Navy SEAL. My uncle was a Navy SEAL, and I wanted to serve my country. I signed on the dotted line, went into boot camp, wanted to go to BUDS, and found out that my eyes were not very good. So I was prevented from participating and trying out for the SEALs. But what I did pursue is a background in mechanical engineering. And what I learned at a very young age is that I hated getting filthy dirty. So when I got out of the military, I started to work at a plumbing supply house in North Plainfield and started to offer, plumbing, heating, hydronics, all that stuff to plumbers and local businessmen. And then my mom one day called me and said a high school classmate she had run into in the supermarket and wanted to get in contact with me. So I invited them over, and when they came over, they tried to sell me insurance. And from there, asked me if I wanted to make some money part-time. Now, being newly married and a new dad, who couldn't make some money or,
use a little extra, absolutely.
Little bit extra, right? So I went to school for insurance. And when I was asked to go visit somebody I knew who was a plumber, went down and sat down and looked in and asked them point blank, do you have a whole life contract? And they said, yeah. So they went upstairs and they got it. And we recommended replacing it, buy term and invest the difference. That's what we were taught. So the next day I went back to the supply house because I was still doing this part time. And I opened up the first few pages of the contract and I had absolutely no idea what it said.
Huh.
So at that point in time, I called up my buddy and I said, hey, do you know what basis of computation means? He said, absolutely not. I said, what do you mean, no? We just recommended to somebody that they replace something that they have, and we have no idea if it was in their best interest. So I started a pursuit over 30 years ago to learn everything I possibly could about finances and then teach it to the public. So that'll bring me to my next point, which is long-term care. But that's sort of how I got into the business. And again, I find, I'm not going to tell you what you want to hear, but I'm going to tell you what you need to know.
And again, there's information up on the screen now of where you can go and see Chris in person and, how you can reach him and how you can have, these conversations. The point of tonight and really talking to you about these things are to prompt you to ask those questions and have those uncomfortable conversations because they truly are in your best interest. And I think it's important, Chris, to point out that you are a fiduciary. That's important for people to know because it's not just that you have an interest in doing what's in people's best interest, but you have a duty to do that.
Yeah, and that's the Reader's Digest version that I use,
Yeah.
that I must put your interest ahead of my own. And I find that really just takes so much pressure because I found that over the years, so many of these financial institutions push products. They push solutions without even knowing what the problem is. Is it in the best interest of the client? So again, I am fortunate. I am a perpetual student. And I believe in, I have a lot of letters after my name, alphabet soup.
Right.
Too many to get into today, but recently I've completed another designation. It's the Certified Long-Term Care designation. So although I've been offering long-term care to clients over the years, I fell prey to a lot of the suggestions on how to market some of these contracts. Yeah. The gentleman that wrote this book is an attorney, and his name was Harvey Gordon. And when he came to New Jersey over 20 years ago, I was absolutely enamored with what he had to say because he was taking an approach which was, you need to have these conversations with the people that you're meeting with. And it was I was a little green, a little young, but it sounded important. And as I started to promote, and if I may, Eric, I have a story that I'd like to share with the audience.
Please.
So, as I was introduced to this, and this was in the early 2000s, I had a prospect who became a client who ultimately became a friend. And Art owned a dental lab. He was a business owner. And after I had learned about long-term care, not only as a business could you purchase this for yourself and your spouse, you didn't need to do it for everybody. Take it as a tax deduction, but also the benefits could come tax-free. What I had a hard time with, he just kept coming back to. He was a business owner. He's like, yeah, it's expensive. Now, as a business owner and being able to take it as a deduction, it was about, let's just say it was about $4,000, $5,000 a year combined for two people. And at the time, he was about 65, right? For he and his wife, right? Yep. But I used to say to him, I say, Art, you're 320 pounds. Your wife is 120 pounds. How many times is she going to be able to get you in and out of bed before she's not able to do it?
Yeah.
I said, it just makes sense for you to put this type of planning into place. So he did that, and he listened to me. He sold his business. And after he sold his business, and he got a couple $1 million, and he was sitting okay, he used to call me and say, Chris, I just got my renewal premiums on this insurance. I go, but yeah, Art, you or she is going to need it. But eventually, around 2013, 2014, he just could not bring himself to pay those premiums.
Oh.
He let it lapse. And he then passed away in 2015. Now, although, and this was to me, he was a very good friend. We go fishing together. We went to Costa Rica together. He was like my second father. But when he passed, Anne, who was a nurse, got ill. She fell and had to go into an assisted living facility. And that was Brandywine down in Lakewood. And within about 3 years, because of the cost of that care, now they were from a blended family. Her children tried to help and take care of, but they almost bankrupted the estate because of the cost of care. We had a plan in place, didn't let it go. So, and that's what I run across is a lot of people know that they probably could get sick, but what if you do? And especially men. Men tend to go, yeah, but it's not going to happen to me.
Right. But your family's history, the likelihood. Is that the kind of gamble that you want to take with your family? And I think, over the past 20 years or so, as we've kind of had these conversations, we've kind of prompted people, you have to kind of look at, the what ifs. I mean, that's the reason why you have auto insurance or health insurance or any other type of insurance. It's to guard against the catastrophic. But, if you've put together a nest egg for yourself and for your family to be able to live on, and then something catastrophic in terms of an illness or debilitating illness happens, that's going to destroy everything that you spent a lifetime to build. And that's, kind of leads us into this next point, Chris, is that what are the options? Because you mentioned in your story that, your friend had said to you, it's expensive. And anytime anybody mentions long-term care, that's what they come back and say is, oh, it's too expensive. I just can't afford that right now. But things have changed a little bit.
Absolutely. And this is why, I really have been on a mission of late, because I was introduced, again, having done this for 20 years, to the insurance industry, because long-term care in general is relatively new. So the fact that they've made improvements, they've started to become creative. So I'm going to categorize traditional long-term care is what I sold my buddy Art.
Mm-hmm.
And that the problem with that is that the insurance industry and the actuaries, it's an unknown arena of risk. And because of that, they are finding that because people are living longer, the costs are going up, that they were on the hook for an enormous amount of money. So what they've started to create are a couple different options. One is asset-based long-term care. Now that is something where you can get guaranteed by reallocating resources purely for the circumstances if you were to get sick.
Okay.
But if you don't use it, you don't lose everything you put into it. So that's usually attractive. Then there's also solutions. Sometimes I don't do reverse mortgages, but usually it's one of people's largest assets.
Their home, yeah.
And sometimes if you're going to stay in New Jersey, maybe it's not for you. If you're going to move, maybe it's not for you. But looking at that as an option, at least should be on the radar and considered. Then there's a term that we use in the industry called linked benefits. So, and this is where I caution a lot of people is that, quite often a lot of advisors will sell it as a true long-term care solution, when in fact it doesn't have the same teeth or ability to cover an event should something happen. It'll help, but it's not all encompassing. And then the last is I will talk about is the Pension Protection Act of 2006. A lot of people over the years, annuities are quite often a financial tool sold in the industry.
Yeah.
You have dinner seminars all
Yep.
the time, people offering. Well, a lot of non-qualified annuities in the past can now be 1035 exchange. That's an expression or a legal IRS term that allows you to transfer one asset from a non-taxable or a tax-deferred vehicle to another. By doing so, you can now incorporate long-term care payments tax-free, where before they would have been taxable. So both the IRS and the insurance industry has created opportunities for families. And I'll leave you with this last sad story because it really shook me up. I did Medicare classes about a month ago at Mercer County Community College.
Yeah.
And a woman came up to me at the second night. And Donna, I could tell from immediately, she had gotten there late. She was flustered. At the end, she came up to me and she goes, I am absolutely, A, sorry I was late, and B, I really need your help because my husband had a stroke at 65 years old and he has been in 4 local care facilities. I found him in the back of some of these facilities and not even being attended to. I've had to take him out. I've been hospitalized. I've sold my home in Millstone, so I knew she had some funds, right? She is being stressed, her and her daughter, by life, right? These are events that could happen. Nobody expects to get sick, and nobody wants to turn around and put their money someplace where they're going to lose it.
Right.
But I try and typically teach people to say, look, let's just move an asset from the left pocket to the right pocket, create some solutions that maybe you didn't have before to give us a better shot of, and and I'm sorry to run down a rabbit hole, but I believe that, if somebody does get sick, let's say it's the husband, right? It's now the spouse, the children. Of course, they're going to take care of you.
Yes, absolutely. And I think that's the important point to make at this point. It's you may be the person that gets sick, but you've got some questions to ask yourself if that happens, because the impact is not just to you. The impact is going to be on your spouse. The impact is going to be on your children or your grandchildren or your siblings, because they will take care of you. And you need to decide a couple of things. And this I think is so important, Chris, to kind of walk through this, because this is where the clarity kind of came for me, is that when we talk about first, if you get sick, then what's the first question? Where do you want to receive care?
Right. And that care, really, let's think about it. It's one of two or three places, right? Most people, when I ask that question, if you were to get sick, where would you want to be taken care of? And I'll say 80-90% will say in my home.
In my home. Yep.
That's where I'm comfortable with, right? Okay. If that happens, and that's where you want to. The other areas are nursing home, assisted living facility, something to that effect. And most people, they don't have a good stigma about them, right? They're viewed as places where we go to die.
Yeah.
So if you choose, regardless of which one, there is no correct answer here. But there is, and I think I mentioned it to you before, Eric, is that we are a part of what I call a sandwich generation.
Mm-hmm.
Your age, my age. I have a mom. My mom is in Florida. She's married. She's 80. She's going to kill me because I said her age on the radio. But if she needs care, I have a family and children. I now have to put my career on hold,
right,
to go down to Florida and take care of her, or fly her up here like we did with my grandmother, where we lost everything and everything was evaporated by the system. This only has to happen to you one time before you become passionate about finding other solutions.
Yeah.
So that's it's a great question.
And think, my thought too is, let's say that it does happen to the husband, and all of the assets that are in that estate now are basically gone. What does that do now if the husband were to die? Then the surviving spouse has nothing left.
And that's impoverishment. And that's absolute, tragedy. And that's the consequences that people, egos aside, it's not scare tactics. It's the probability and likelihood if you were to get sick, right? And this is the thing, is that we don't like to, as men, think that something could happen to us. We're providers of the income. If you're the primary income earner and you're female, perfect, right? You also have that responsibility to take care of the household, right? But if you become ill, right, there is consequences to your loved ones, because they now either have to put their lives on hold or consume an asset that was maybe earmarked for your current lifestyle.
Right. Or to leave to children or to grandchildren. I think all of us know somebody in our lives, a friend, a relative, a coworker, who has had a mom or a dad or a grandmother who's gotten sick, who, have had to put their lives on hold and become a caregiver for that individual, and the financial ramifications to do that. Even if you're not directly paying for that care, if you've, as you pointed out, put your life on hold, or you have to take a leave of absence to your job, or you need to do these other things, you're depleting your assets and your earning ability and all of those other things as well.
And again, having walked through the forest already, having had it happen to my family, seeing the confiscation of wealth, that's one aspect. But what is becoming more and more obvious to me as I grow older and wiser is the impact it's having on the loved ones.
Yeah.
The children and the grandchildren, and I'm going to bring this last one up, is my son. My son recently, with my ex-wife, had to be a partial caretaker for his grandmother. Her last 3 years of her life could not speak, could not write, and was basically bedridden. And he would say to me, Dad, I do it because I love her. But my ex-wife had her brother, and the fracturing of the family dynamics,
Yeah.
the tension, the accusations that one is not working as hard, or he would call me up hysterically crying because the person he loved, his grandmother, that absolutely, he was like, I don't mind giving her a bath. I don't
Right.
mind changing
Right.
her clothes and feeding her. But he goes, the smell when I walk into that house is tough.
Yeah.
And once you start to, and I'm now hearing that firsthand.
From a
That's why.
17-year-old. Yeah.
Well, now he's 34.
Yeah. But at the time.
No, this is.
Oh, I'm sorry. Okay.
This is
Yeah.
last year.
Okay. Wow.
So this is recent, and why again I'm passionate about that. As I share some of the stuff that is available, I encourage people, if you're listening to this, dismiss what you think you know. If you've looked at solutions before and you've already made determinations that it was too expensive, not for you, not yet, you don't qualify, I have found out that even if you have dementia and you're already spending the money, insurance companies have medically underwritten annuities that they can help cover people. It's leverage.
Right.
Now, it's not going to be 100%, right? But maybe if you're spending 10 grand a month, maybe they'll give you 1250 because you went through an insurance company, and they are experts at managing and hedging risk.
Yeah.
That's what they do.
Look, that's the thing that kind of struck me as we started looking at that. And, I think we've all been at a cocktail party or a dinner or something like that. And, the issues of retirement, right? Because at our age, we're thinking about that. We can see the finish line from here. And a lot of you can as well. So you're kind of looking at that. And maybe 10 years ago, maybe 20 years ago, when you first started financial planning, or you first opened up a money market account or a 401k or something, you looked at some of this stuff and you looked at what long-term care looked like at that point and went, there's no way that I can possibly afford that. A lot has changed. So, Chris, let's talk about things that have changed. I think all of us understand what the risks and what the potential needs are here. How has it changed? What products are available? Understanding that, there's no cookie cutter solution, but what are the options that are available today that weren't available 20, 30 years ago?
So I'm going to start with the federal employee arena. And because I used to do classes over at Rutgers, and that's why I'm familiar with, the federal employee and state employees, they have a different set of opportunities. Because for the private sector, there are not pensions anymore. Very rare. I call them unicorns.
Yep.
So quite often when I'm sitting down with somebody that has worked for the government, whether it be the state or the federal government, that they have already incurred income through a pension, and they have a 403B or they have a TSP. But because they're getting a pension, usually a significant amount, they don't necessarily always need that money that's in the 403B, which equates to a 401k in the private sector, right? Or the TSP. So what I found is that there are companies that it's called asset-based. So basically it's leverage again, but you would move, let's say 100,000 or 200,000. And if you're young, healthy, it's lightly underwritten, not completely non-automatic enrollment, but it's slightly underwritten. If you qualify, 200,000 could be leveraged to maybe 600,000.
Okay.
So that would give you a pool of money to pay for, and on a couple, and sometimes for life. So here's the thing: is that the average long-term care stay in a nursing home or need is roughly 4.1 years. I don't like to get into statistics, but that's an average. At roughly $120,000 a year, you're looking at a $500,000 math problem. Right. So to be able to create...
But think about that for a second, because I want to stop. The numbers are important, right? Nobody likes to talk about numbers. But just under that scenario, $500,000, how much have you saved in your 401k? How much have you put away? How much are you expecting in Social Security income? And could you afford to take $500,000 out of that equation? that's really what we're talking about, right?
Exactly. And this is why people of means sometimes will say, well, I'll self-insure. Well, that's not necessarily how insurance works. Insurance is pooling together.
Mm-hmm.
What you're basically saying is, I'll cut the checks as we go. I'll self-fund. There's a difference.
Right.
So, back to your question, which is, hey, what other options are there? Being able to start to either create some type of plan to put in case of, and sometimes it's a whole lump sum, sometimes we can do a premium, but it's guaranteed, meaning that they cannot raise the rates. So
Okay.
I have a client that right now and I've just helped him cross the finish line to retirement. So I've
Good
been
story.
working with him for 10 plus years.
Yeah.
And we did long-term care on his wife about 6 years ago. But the reason I didn't do it for him was because I wasn't completely certain that we had enough assets to get him across the finish line. And female morbidity, not mortality, but morbidity,
Mm-hmm.
that's a fancy way of saying that the likelihood to get sick, women live longer. And if
Right.
we're going to live longer, the likelihood of care is greater. So I waited for him until we got to this point. But now we've come up with a solution, and it gave me great pleasure to show him in the model. I said, listen, we can start to put $20,000 a year into a plan for 10 years. So the same $200,000 is going to go in for money that he didn't really need because we've been paying attention for the last 10 years. And that gives me a lot of pleasure, is helping people to figure out some type of solution to help them if something should happen. And if it doesn't happen and he doesn't get sick, the assets go back to the family.
That was going to be my next question. So that's a lot of people looked at long-term care and said, I'm going to be paying $2,000, $3,000, $4,000, $5,000, $6,000, $7,000, $8,000 a year for something I may never use. And then poof, that money's gone.
100%. And that's where the industry has actually improved. So being able to offer solutions like that to say, hey, look, now you do have to qualify to an extent,
Yeah.
but it is not as bad. Like life insurance, they're basing on the likelihood that you're going to pass away.
Yeah.
Right. So it's fully underwritten, and they've made major improvements in that arena. Long-term care is based on 2 out of something called ADLs, activities of daily living. So those are the triggers that make a plan, which is under the IRS code 7702B. That's what makes it a true long-term care policy.
Okay.
And those are the rules that allow us to start to look at, and this is what I do. I look at people's overall picture, try and understand what their cash flow needs are now. Then, do we have an income gap? That's the first. Are we running short on money? If we're okay, or if I can make some suggestions, take less risk, whatever those solutions are, now we start to plug the holes. Those holes typically fall into the arena of long-term care. That's usually my first area.
Okay.
And I just had this conversation. I just met with a new client. And as I was starting to work with them, I said, hey, listen, the next thing we need to do are your wills, trust, powers of attorney,
Right.
healthcare directives. And he goes, yeah, I don't have any of those. And I go, that's okay, because I work with one of the top estate planning attorneys and elder care attorneys in the state. We'll get you there. These are the things, Dina, she's awesome, Ed Wax's office.
Mm-hmm.
And then, so they're elder care attorneys, estate planning attorneys. And then I have, unfortunately, I had to call an elder abuse attorney. That's, like I said, that woman,
Yep.
Donna from Mercer County, Barry Sugarman out of Bridgewater, it's a sad scenario, but it's interesting because he came to me for college planning 10 years ago. We put him into a long-term care policy. He's been contacted by the company. $50,000 went in there. Sorry, Barry, I had to disclose some information. But it's leveraged at $600,000 because of when he bought it.
Wow.
He goes, this is the best thing. He goes, I tell my friends about it, and they go, they don't even offer that contract anymore. These are the types of things with a little bit of thinking and strategy. We can help people to put solutions in place that weren't the primary objective initially, but actually help people to protect their family in the future.
And doesn't jeopardize the amount of money that they've set aside for retirement. And I think that's the real important thing is that, everybody thinks you're taking, money away from this to be able to do that. And I lose that as an asset. And that really isn't the case anymore. And look, if you've done the Google search of long-term care or long-term planning, and you look at some of the costs, or there's some kind of computer algorithm or quiz or question where you just kind of plug and play all of that stuff. And I think that it's so misleading because you're looking at algorithms online that aren't really reflective of you. So if you've done that and dismissed the idea, there's the advantage of sitting down with a professional like Chris and his team, because they're going to hold a mirror up to your face and they're going to say, is this you? Is this what you look like? Is this correct? And then start to come up with that plan. And, look, the internet can be a wonderful place, but it can also be very scary and detrimental to your retirement because you're plugging in numbers and there's no basis behind them. There's no story behind it. It doesn't fit you.
And again, I think that's where my experience, what I've learned, and I try and share with folks. A lot of people are what I call do-it-yourselfers. Mm-hmm. They've tried, they've had bad experience with an advisor, got sold a product that maybe wasn't what they need or thought it was. Right. It happens, right? That's part of why I promote our philosophy. I have a very easy process, and that is let us collect some high-level data.
Right.
Let us see. I don't need sensitive information. I don't need your Social Security number. I don't want your tax returns yet. I don't want your brokerage statements yet. But what I am going to ask you, that your Fidelity guy, and I'm sorry if I'm not allowed to say that on the radio, or your Vanguard, or whoever these larger institutions that have wealth departments, because I hear it all the time.
Yeah.
And when I ask them, well, what did they ask you what you're spending right now on your expenses? Not I'm $4,000 a month or $5,000. I mean, into the weeds, comprehensive analysis. What's your budget? What's your cash flow? We need to know that, because as an expert in retirement, I'm going to tell you what to be on the lookout for, what could go wrong in retirement. We're going to plug those numbers into a model, and then you're going to agree. Are those your numbers?
Right.
Then I'm going to apply math, that 4-letter word, to say if something goes wrong, we've now accounted for inflation. We've accounted for Social Security. We've accounted for pensions. We have accounted for a rate of return. And although, people use a static number, I'm not going to get too deep in the weeds today, but we've looked at these things and said, hey, is this you right now?
Right.
Do you agree? You are here.
Yep.
We go to the mall. There's a store I want to go to. I don't know where it is. Where's the first place we go to? That's the directory.
Yeah.
That's what I build, is that directory. Then you tell me where you're trying to get to, and I'll help you find the most efficient path. And one of those areas that can cause that to be an absolute landmine is a long-term care event. What happens if that happens to you? And could you have done something ahead of time to deflate that, reduce that risk? And that's what I hope people to understand.
Yeah. And again, I think it bears repeating is that this is not just a you problem, right? If there's a catastrophic illness and you do need long-term care, this impacts your spouse. It impacts your children, your siblings, your extended family, your grandchildren. We all hope to be able to leave something behind to our children or grandchildren for college or some type of an inheritance. And then imagine all of that is gone. And as Chris has pointed out here on a couple of occasions, even if you use the stock numbers, right, of 4.1 years and what the cost of that is at 100, 120,000, you're talking about $500,000. Could you or your spouse survive in retirement if you took $500,000 off the table of everything that you had saved? And it's a great process. And it is that thing where you have to go through and you have to answer some questions, and you got to ask yourself some questions. And I think that's the scariest thing. First, in terms of long-term care, it's the cost. I've seen how much this costs. This is expensive. Well, we've talked about options that,
right.
I lose all my assets if I do that. No, we can figure out ways to protect those assets. But then it's that taking that mirror and turning it onto yourself and really truly understanding where you are and where you want to be. Those are hard conversations to have, but that's where you have to start.
Agreed. And it isn't easy. And we are human beings. We're not robots. And sometimes we tend to either take an ostrich approach towards things.
Yeah.
We tend to wait until it's a crisis, or maybe something's happened. Once you get sick, I always use this analogy. If you have a car accident, you can't pull into the local car insurance company and say, hey, insure my car. It's too late. That is not the case with long-term care anymore. There are still solutions, even if you've already been diagnosed, even if you're already receiving care. So, you don't know what you don't know. And so from there, I try and help folks to just, first of all, understand where you're at. What's your concern? Who's going to be affected by the decisions you either make or don't make today? And can I offer a better strategy? There's no harm in seeing what else is out there.
And for that initial consultation, there's no cost involved.
There's absolutely no cost.
Information on how to reach Chris and his team at Professional Planning Services and their website up on your screen right now. We are getting a couple questions in the live chat tonight. And, one of the things Barbara asks, and I think this is an assumption as well, is that it's my understanding long-term care benefits cover a very small portion of long-term care costs. And she puts a couple of examples in there. $155 per day, $4,600 per month, et cetera, et cetera. What do they cover? I mean, is there a gap in that now?
So it depends on the type of plan that you actually purchase. And this is where there's a lot of gray area.
Mm-hmm.
So what Barbara is referring to is reimbursement.
Okay.
So, and that was the type of, back, 20 years ago, 30 years ago, in its infancy, as solutions were offered, people would put in as $100 a day, $200 a day, $300 a day, and then put an inflation rider on it. And those rates, those are traditional policies. And those rates are not guaranteed. So what's happened is the insurance companies started to have claims experience. And as they started to go through, if it was a reimbursement policy, and let's say you were a caregiver and you are not a skilled nurse, so you're now taken off from work, you cannot be paid,
mm-hmm.
and now the expenses, and maybe it's only not covering it. So here's the thing that you thought was going to cover you for the event. You thought you did the right thing, and here you find out you're unprotected. So it's absolutely should be scrutinized. And I'm not saying that we get rid of what we had, but we have to understand what we have. What they've stopped selling a lot of now is indemnity policies. These are Cadillacs in the traditional types of long-term care. Indemnity policies is what I did all for my mom. But this is why, so I'll leave you with this. There are so many companies that have left the long-term care arena. So that's why the federal employee benefits used to only be underwritten by John Hancock. They left the marketplace for the federal employee space, stopped offering coverage because they were getting smoked on claims. Genworth in 2015, 2016, I think it was in $6 billion loss. These companies had started to put products out there, and as they were handed claims, even on a reimbursement basis, were getting smoked. So now what's happened, and this is why I find that having some type of policy that's a hybrid, right? And these hybrid policies are typically either an annuity linked to some type of life insurance. If you can get those types of policy, we can do asset-based long-term care. And then depending on how the claims come in, quite often we can actually take a family member and provide that benefit for the family member. So there's now people that are maybe having to take off from work to help mom can actually get paid or compensated. There's a lot of benefits. Like I said, in the last 5 years, a lot of the solutions have been created where before there were none.
And again, that's why it's important that you sit down with somebody like Chris and his team and at least have that initial conversation. If you had one of these old school policies like we just talked about, is there a solution for that? Can you swap it out? Can you get rid of it? Can you make it part of the overall plan? What do you do with that if you've got one?
I like your last option.
Okay.
I am not a fan of replacing contracts. An annuity, if it's a not under the Pension Protection Act 2006 for ADLs, which is activity of daily livings, maybe we will. That's a 1035. That is a replacement. But as a licensed in New Jersey and a fiduciary, disclosure, disclosure, disclosure. Sometimes there's surrender fees. Sometimes there's costs. So you have to go through that with fine tooth comb.
Okay.
So if somebody has an old policy, typically we'll start to look out and build that model, take that into consideration, compare that to what are the costs. And remember, we can't cover 100. I'm not saying we can't. It's unreasonable, I think, for most families to try and cover 100% of the possible exposure, right? We'd be walking around with a life preserver this big, right? It's too much to ask for. But being able to preserve, if it was a $500,000 event, maybe we can cover $250, $300, a portion of it to be able to offset some of that exposure. And then, again, family members that are now being forced to be caregivers, which, and now they're also taking care of their children that are either in grade school, high school. college, and now you got to take care of mom
Yep.
and dad.
Yep.
We need to have these conversations. And this is why I think it's also, I have parents too, but I've seen this time and time again. My dad has passed away, but when you try and talk to your parent about money,
Yep.
they don't want to talk about it
At all.
What are you
Nope.
trying to do? We're going to do a Medicaid spend down
Yeah.
protection trust. We're, all of it. But you go to mom and dad and you say, hey, I think you should do. Oh, you just want access to my money, and it's not the
No.
case. So you have to sometimes integrate that professional, and that's why using either law firms or financial advisors, where you can't tell a parent what to do with their money, but you can help them to think about it through a different set of lenses.
Well, and I think that's part of what we talked about tonight, right? Is what's the impact to your children, your grandchildren, your spouse, your siblings? It's that ripple effect. We get blinders on and we go, oh, if this happens to me, I'll be fine. Well, that may be true, but there are collateral concerns,
Ripple
around
effect
that.
was
Yeah.
a great analogy.
Yeah.
That is absolutely.
All right. So talk to us about, so I would encourage you to give Chris and his team a call, or at least check them out on the website and have that initial conversation, at least learn some of the things, that you don't know and the right questions to ask. But you can also go and see Chris in person. You've got a couple of events coming up here, in the not too distant future. Let's talk about those. This is going to be at Rutgers coming up.
I got 3 events. One
Yep.
will be back at Mercer County Community College. That will be on May 31st. That is my eldest daughter's birthday. So
How does she feel about that?
I will be working. She is also the mother of my 2 grandchildren. So
Mhm.
Jessica, hello. I'm sorry I got to work. And then, so that will be in West Windsor. And that event, we had, typically we already have some registrants. So everybody knows I did 2 Medicare events, and I hadn't done, because of COVID, I had not done a live event in almost 3 years. So when we did the Medicare event to teach people what Medicare does not cover, and Medicare does not cover long-term care, right? So that was a really big takeaway. We had almost 70 folks at those 2 nights, and we gave them first dibs to register to these 3 events. I had 4 on the calendar. Rutgers had another conflict, so I had to take a Saturday off the table. I've taught classes and workshops over at Rutgers before. In the classrooms, when you're there, they are designed for youngins. So the seats are very close and tight, but there is a little writing area. And the reason that I share that with is that room that I've rented out at the Rutgers Business School is a Wednesday night, is June 14th. And then it is also a Saturday morning from 9 to 12. So 6:30 to 8:30 on June 14th. On June 17th, it is from 9 o'clock in the morning to 11 o'clock. But it only seats 100 people. Now, that might sound like a lot, but here's the issue. I want you to bring not only yourself, bring your parents, bring your sister, bring your brother, bring your mom, bring your dad, bring your children. But it's first come, first serve. Once we register and you put in the amount of attendees and we're done, that's it.
Then it's closed.
So I just wanted to stress that. But Rutgers Business School in New Brunswick is 2 nights there, or a day and a night.
June 14th, 6:30 p.m. June 17th, 9 o'clock. It's free, right?
Yes,
free.
sir.
It's free, but you do have to register to be able to do that. In the live chat, you'll see the link where you can go to Professional Planning Services and sign up. You can do that right now as we're wrapping up tonight's program.
And I will give another tidbit, because my staff went through all this work, and I will point this out. You can go to PPS-LTC. That is a quick link, so you don't have to go to my website. You can go there. That will bring you immediately there. Or if you want to register directly, we have a concierge service, 888-306-3842. And you can register for that as well right there.
One more time.
That is 888, my eyes are bad, 306-3842.
When we started this 20 years ago, we were a lot younger.
I was. I still couldn't get into the Navy SEALs.
and a lot farther away. Look, Chris is a great guy. I've known him a long time. Go to one of these events. If you're not going to call and schedule an appointment, which you can also do on the website. As soon as you go to your website, there's that little pop-up thing where it says, you can schedule now. So you can schedule an appointment online, have that initial conversation, go to one of these events, and just start getting educated about some of this stuff. And I think once you start to become educated, and the scariness starts to go away, right? So we've talked about some of the options. It's not what you thought it was or you were told it was, 10, 15 years ago. There are other options that are not as scary. Oh, okay. All right. So that barrier is down. Now, how do I talk about some of these things? Have that conversation. Go back, rewatch this program. Share that with, the people that are in your lives that are important to you so that it doesn't become such a scary thing when you start asking these questions now.
And I absolutely agree. And one of the things I learned from the Medicare event when I shared the story about Donna, what I didn't have was because the class we weren't selling anything.
Right.
As a free attendee to learn about Medicare, because Medicare and the rules and the government are complex. So that's why we did it. When she came over and shared her story about what was going on, I felt something was missing. And that's why on that site, PPS-LTC, for the person that has a burning desire right now, I got a situation right now. That initial step just allows you not to have to wait a week or 2 weeks. That if you come to that event and then you come up to me and go, hey, I got a situation, I'm going to direct you back to that form. It's a JOT form. It's something you can complete. It's not overly sensitive data, but it's helping you to feel like, let's get some other eyes on your high level scenario and see if we can put a plan, some type of solution together for you. Ultimately, you're the captain of the ship.
But a high level that is at least specific to you. Right. I think a lot of people think when they go online and they do that high level, where you plug and play, they ask for all it, but that's still not you. That's still you because you're
boilerplate,
right.
100%.
And it's not an accurate snapshot, right. And that's why it's important, I think, to do that. Attendees at these events, again, coming up, everybody's going to get a book. It's a great book.
If it's tax-free benefits for long-term care in a post-COVID
environment.
World. So this has been updated to include a lot of the topic solutions, details we've gone in today. We will hand out, every couple will get a copy of this book. So I co-sponsored this. My business partner, Don Quante, I call him the godfather of long-term care. He authored the book, but his team and my relationship with a lot of people in the industry, I am certain there's a better solution than just doing this as an ostrich or a hope.
Or a hope.
Hope is not a plan.
Yeah, hope is not a plan. And so it's worth it. It's worth it to you. It's worth it to your family, your spouse, your kids, your grandchildren, your siblings that, if the unthinkable does happen, is going to devastate them. So May 31st, Mercer County Conference Center, that's 6:30. Then we go to Rutgers, June 14th, 6:30 p.m.
Both of those are Wednesday night.
Yep.
So account for traffic.
Yep. And then June 17th is a Saturday.
Saturday
at 9 o'clock. Tax-free benefits for long-term care in a post-COVID world, just like everything else. COVID changed all of our assumptions, again, and need to account for that.
Yeah, and my model now is like, listen, come meet me or live initially. But then eventually our conversations, we're going to do Zooms. And if somebody wants to meet me in somebody's conference room someplace, great. But right now, I think that this allows me to serve a larger part of the community, and it is so important. I've just been hearing more and more people needing some type of solution where before they were just, I've already looked into it and it's not for me. And then they find out that, everything was stripped away from them by the system.
Yeah. And look, so you have options. You don't know what you don't know. There are questions you need to be asking. Chris and his team can help do that. Whether you schedule an appointment with Chris directly or you come to one of these events, again, the events are free, but you do have to register because space is limited. And if you register, Chris will reserve the spaces for you. You get a copy of that book. You get information. More than anything else, you get information. It's not a high pressure sale of any product or services or anything like that. We're talking about information and education here. And, that's the one thing, Chris, that I've valued about our relationship over all these years. is that it's about education.
Yeah,
It's about
nothing will be sold. Leave your checkbooks and wallets at home. This is absolutely about, as a fiduciary, and that is my promise to you. I must, by law, if there's a cost or a fee to you, you will know well in advance.
Chris Lester from Professional Planning Services. Great to have you in the studio today. Thanks for coming in and sharing this information with our listeners. And we'll see you at those events again in Mercer County and also at Rutgers at the Business School in New Brunswick. Log on to the web address that is on your screen right now to pre-register. And on behalf of all of us here at New Jersey 101.5, grateful to Chris and his team at Professional Planning Services for joining us on Access New Jersey tonight. I'm Eric Scott. Thanks for watching.